we've always been putting others first. I mean, that's our mindset. We're always the last one at the end of the day to realize any success in a project, and I think that's always been our mindset.
Welcome to the Build to Billions podcast, where we got successful entrepreneurs and investors on their journey from millions to billions. And we believe that the key to scaling and compounding your wealth starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth in life so you can give more all of it away to help MVPs, the most vulnerable people. My name is Brett Swartz, and every episode I'm joined by the world's top entrepreneurs, millionaires and billionaires, and they share their secrets, wisdom, and insights with us so we can all level up our faith, our impact, our compounding interest and opportunity to grow our wealth in life. I'm so excited about our next guest. He's out of the great state of Texas in the Fort Worth area. And he specializes in helping others build wealth in a way through real estate. He's the president of brokerage services with the Woodmont Company. And they've got offices in Dallas, Orange County, Phoenix, and he's responsible for the management operations of the brokerage department, encompassing a retail portfolio of active in 34 states, exceeding 23 million of GLA. In addition, he's focused on the development and implementation of the strategic growth initiatives for the company. And since joining Woodmont 2008, he has continued to work to bring added value to each client and customer in all phases of the commercial real estate transaction process. In short, he's an expert in commercial real estate, investment, brokerage, and so much more. Please welcome to the show with me, Grant Gary. Grant, how are we doing?
Brett, we're doing well. Excited to be here. Appreciate the opportunity and the consideration. Glad to be with your audience.
Absolutely. Grateful to have you. And for our listeners getting to know you for the first time, would you give us just a little bit more about your story and your current focus?
Yeah, certainly. Happy to do it. You did a good job summarizing there. But as noted, one of the principals here at Woodmont, a short background on Woodmont. Company was co-founded in 1980. We are a full-service, retail-focused commercial real estate firm, as you said, headquartered here the Dallas-Fort Worth area. But over the life of the company, have operated coast to coast. Operate three primary divisions within the company: a brokerage division, development arm, and then an asset management, property management arm. Within the brokerage division, one of the roles that I'm involved with on a day-to-day basis, we've got a project leasing team. We have a tenant rep team, capital markets, as well investment sales. On the development front, which I know we'll be talking about today in particular, over the life of the company, we've developed 15 million square feet, primarily of retail shopping centers, and that's across 34 states. It actually started with a relationship in the early days with Toys R Us. When they were in their heyday of expansion, they were an anchor to a number of shopping centers. And, like everything else, we did our first project with toys. We were successful. That opened a door to another opportunity that then led to relationships with the Rosses, the TJ Maxxes, the Ulta, the PetSmart, Petcos, many of those anchor tenants. And so through that process, again, developed, I think, over 50 Toys R Us anchored centers over the life of the company. At the same time, about 6-7 years ago, we had an opportunity in the childcare space to expand our single tenant net lease development platform. We'd actually worked in the childcare space, starting in tenant rep division here in DFW for a group called Kitty Academy just over 15 years ago. I've been with the company 16 years now myself. And at that time, Kitty Academy still was one of the leaders in early childhood education. They only had, one location here in DFW, and we were fortunate to be able to help them in locating their first location. Fast forward to 6-7 years ago, they were looking for a development partner that could scale with them programmatically around the country in a build-to-suit program. A lot of their growth had been individual franchisee development, or perhaps landowners just doing a one-time build-to-suit. But there was so much growth, there was such a need for quality childcare across the country. Their biggest hurdle was real estate and construction development.
Got it.
That's something
we're going to dive onto that in a second. This is so good. So amazing background, tons of experience, right? And we're going to dive into in particular, basically single tenant net lease and opportunities for build to suit for these childcare and the different ones that you're doing, and some returns and what those look like and such. Before we go all there, Grant, I do want to take one other step back. I believe we've all been given certain gifts in this life, and these gifts have been given us to be a blessing and help to others. Some people call them strengths. I call them, superpowers or God-given gifts that he's given us. I'm curious, who was Grant growing up? What was the one or two, maybe gifts that you believe you were given, and how does that help how you help and bless people today?
Sure. No, Brett, that's a great question. And I'll just say this in terms of, growing up, I grew up in Austin. I'm one of the few that was actually from Austin today, but I'm glad to be up here. Went to TCU here in Fort Worth, actually. I was one of those fortunate from a business side. I always knew I wanted to be in real estate. Always knew I wanted to be in real estate development. So I actually got a real estate license while I was still in high school. I was at TCU, and I knew I wanted to be in real estate development, and Woodmont at the time, and still is the largest retail focused brokerage development firm in Fort Worth. And so I knocked on the door and said, "Do you have any internships?" So I was actually an intern the summer after my sophomore year. Answered the phones, took the mail, made copies, cleaned the fountains in the front. And so, I think one of those fortunate paths again was knowing and then being able to fulfill the opportunity from a real estate perspective. I think the other, gift, if you will, again, gift is just being thankful, for the opportunities, but interacting with people. I mean, so much of what we do is about people, and understanding their needs and their wants. I mean, I think that's really what has driven opportunities for myself and driven opportunities for this company. I mean, really relationships are what have driven Woodmont, really since its founding and continue to
Awesome.
do so.
Fantastic. Well, yeah, seeing opportunity and executing, and then the people and looking out for and helping others. Love it. Those are great strengths. So now let's dive into the topic at hand. Like, what's the number one secret to making, I guess, a nice profit margin when it comes to single tenant, build to suit, leasing deals? How are you guys, structuring that? And then let's get very specific on like a live deal so we can kind of bring this thing to life.
Sure. Yeah. I mean, I think just to go back to the beginning, in a sense, it's all relationship driven. I think that's number one. I think when you look at, especially within our industry, commercial real estate, and then the even smaller, niche of, both the retail and the childcare focus, having the relationships with the operators, nurturing those, that's really number one. A lot of this development program is not necessarily going out speculatively and looking at opportunities. It's really starts with the relationship. Number two is really understanding the entirety of the development process. Number one, I think that's going back to one of the strengths of the company. We've built teams, that align with the corporate real estate teams for each of these childcare groups from the very beginning. Having the brokerage arm, we want to be involved in the site selection process, and we're handling site selection coast to coast specifically for, in a lot of cases, childcare development opportunities. So knowing the market, having the ability to be involved from the beginning so that we're seeing the potential pitfalls of a potential development site early, not just looking at it from a real estate perspective. What are the detention requirements? What are the impact of the tap fees? Those are, majorly impactful and very, to every jurisdiction across the country. So that's another item. What design requirements are in place? What's the timeline? Do we have to go through a CUP, an SUP? Understanding that process, because it all ties back to the underwriting and how that you're then presenting the opportunity. Same time as understanding the tenant's business. I mean, I think, our view is that truly this has to work for everyone, from each stakeholder throughout the process, from an investor to the operator to the franchisor, and to ourselves. And so understanding what makes that group successful, understanding the market-based need, understanding what those tuition rates are in a lot of cases, or what's driving their ability to pay rent. So I think taking all of those pieces, and then taking that through the underwriting process is one of the keys early
Okay,
on.
got it. So this is key. So the number one secret is relationship driven with these tenants, right? Relationships with the lenders, relationships with, you guys do brokerage services, A to Z, everything, soup to nuts, like all of it, you're able to understand deeply and then connect all of it and execute on it. That makes sense, right? And then, and making it a win-win for everybody, is the key. It's got to be a win-win. You had so much experience with this, so you probably got it down with the millions of square feet that you've developed. You've got it down to a science, but there's a part that's an art as well. What would you say in this marketplace is really that art piece that, it takes a group like yourself that has the experience and the staying power and the relationships, what has maybe adapted or changed in the last 12 months, given the, the current interest rate environment? What are you seeing?
Yeah, no, it's a great question. And really that's the beauty and the challenge and the opportunity all kind of rolled up together in this business overall. No project, no development is the same. There's going to be different nuances in each project. We're a firm believer in lessons learned. I think having completed now over 55 childcare build-to-suits around the country over the last 8 years, there's been a lot of lessons learned. I think understanding the nuance in each jurisdiction, as an example, there's varying licensing requirements state to state. So understanding what those are in Colorado versus Chicago versus Omaha allows us to mitigate the timeline, mitigate, the risk, of items that, we've learned collectively with the corporate teams as well, as we go forward. So I think that's one of those aspects. I mean, the underwriting, understanding the capital markets, today, what are those sensitivities? Where do we think those are going? We certainly don't, take the position of having the crystal ball, but we're out there having those conversations with those that are on the front line. And one of the benefits of also having in-house investment sales, we're also on the eggs of the asset. So I think when you look at the full life cycle, we have real-time data, that we're able to build that knowledge base that allows us to continue to go forward and mitigate the risk and create the art, if you will. Right.
Also, love it. Again, we're speaking with Mr. Grant Gary. If you want to learn more about their company, what they're doing, featured properties, go to woodmont.com. That's woodmont.com. They are a full service real estate development company, retail, single tenant, focused right now heavily in creating the childcare spaces, which is amazing. Let's talk about some live deals, Grant. So on average, you said you get 55 childcare built to suit so far. How long does it take from the time that an investor may put $1 in to the time that it's completed? Are investors, is it a Reg D type of syndication format as a fund? Like, walk us through a little bit of those details. And then what's kind of the average return that is projected for some of these investments?
Sure. Yeah, great questions. Again, appreciate the opportunity. If we were just looking at a single tenant net lease childcare build to suit today, and in fact, we've got two projects that we're working on actively in the greater Omaha market, one in the northern suburb of Bennington, where a lot of the new growth is, where a lot of the strong school districts are, and then another with those same characteristics in the southern part of the market, Papillion, as well. So both of those, again, usually sites about, I'd say, 1.25 to 1.5 acres. There's other factors that contribute to what that, right sizing of the parcel is. But to your question about timeline, typically you're from, the day the dollar's invested, typically that's 24 to 36 months from the exit. What we're doing during that time is going through the entitlement process, then going through the construction process. Depending on the market, construction timelines usually 8 to 12 months. Some of the colder weather markets, maybe closer to those 12 months, which we're always thinking about and trying to mitigate when we're building. In fact, we're just completing a Kiddie Academy this week in greater Cleveland market. So 18 to 24 months, again, from entitlement, construction. There's usually 12 months for the operators where we've got half rent in place, allowing them to ramp up their enrollment. And they would then be taking it to the market on an exit from that standpoint.
Okay, so what's the average, cost, including carrying costs and all of that, and then the average exit price net of fees?
Sure. So again, targeted returns have been 20 on the IRRs. Typically on the pricing side, we're coming in usually with about a 200 basis point spread from return on cost to the exits. Today those are in large cases, I'd say to 9 to a 9.25 return on cost, and are trading in that 7 to 7.25 cap. As I've said, we've sold over 30 of these childcare facilities ourselves and have that very real-time comp data on the transactions.
Okay, so let's break it down. Like, there's the average build to suit, cost $3 million, $5 million, $4 million. Like, what is it? And then what do you average, exit price that you're selling it for?
Yeah. So we're typically in, and the costs are varying market by market, certainly. Mm-hmm. But I would say usually if it's on a $6 million project costs are looking at probably a $7 million exit.
Okay. So about a $6 million project cost that includes the entitlement, the carrying cost, all of that. And the average exit price is about 7 million. So it's about $1 million total profit. Is that a fair summary?
Correct. Just
Okay.
obviously talking in round numbers.
Yeah, round numbers. Okay. And then it's going to take about 24 to 36 months to complete. Okay. All right. And you mentioned a 20% IRR. So if somebody puts in, how do you guys do a waterfall or preferred return, or how is that set up? And
Right.
then
Great
what's the
question.
split?
Typically, we're talking about an 8% preferred return that accrues
Mhm.
from the moment the investment's made. And then typically a split after the preferred, I'd say upon the exit, the preferred return less the debt. Typically we're securing, I would say, loan to cost of around 65 to 70% on these projects. The balance of that would be the equity. So get 8% pref, retiring of the debt, return of principal, and then typically a split, 50-50 from that point between ourselves and the investors.
Okay. Interesting. Okay. So someone puts in like a million today, and yeah, they would expect it to get, let's say it takes 36 months, right? So that's 3 years. So yeah, that's 80,000, that's accrued for those 3 years, right? And then
Correct.
you're looking at they get their million back plus those, 80 times three, and then a 50-50 after those other things are paid. Is that a fair summary?
That's correct. Yeah, the remaining free cash flow. That's correct,
Mm-hmm.
Brad.
Okay. And then you find that and in the first scenario, you said there's $1 million in profit. So what's the average investor capital that's coming in for the equity side on a $6 million deal?
Yeah, correct. It's usually $1 million to $1.5 million.
Okay. So about 1 point. And then are you guys putting in your own capital into the equity side, or are you typically raising the 1.5 million?
We've done a number of structures, Brett. Certainly we've been prepared and have invested our own capital on a number of
Yeah.
occasions. I think as we've often said, we want to have the right structure that works for the right investor at the same time that can be programmatic. I think as we've looked at ourselves, the development pipeline, the value that we believe is scale, and continue to roll out. The need is there. As I said, it goes back to the need for quality childcare across the country. And the biggest hurdle for those is the construction and the development challenges. So, I think we've always been willing, to find the right solution with the right partner that can be programmatic as well.
Okay, excellent. Thank you. Thank you for answering the questions and getting into the details there, the weeds. It's always great. So again, great, everybody. You can learn more by going to woodmont.com. Excellent. And so do you feel that childcare single tenant build to suit is like the primary 50% of the stuff that you guys are doing now, 80%, or what other places are you really focused on for different retail or different developments?
Yeah, no, that's a great question. So I would say yes, childcare today is probably 50 to 60% of our activity. That said, we have the relationships, we've built the specialty within that space. As I said, we think there's a pipeline for tremendous growth. So we're still very bullish on that space overall. That said, as I noted, really, this falls under the single tenant net lease development department program that we've built here in the company. So we're working on other single tenant net lease developments. In fact, I'm going out to Montana tomorrow, where we're working on several Sherwin-Williams build-to-suit opportunities. So, I think Sherwin-Williams, we've done several Starbucks, we've done several multi-tenant retail strips. So we still see growth opportunities in those areas. That we think fall within the same skill set. A lot of the same principles would apply as far as programmatic site selection, entitlement, construction development, and being involved throughout that process. So that would be one. Another angle, again, still in the retail space, is shopping center acquisitions. So as I said, we've developed 15 million square feet of power centers, as we call them, around the country. Usually somewhere in the 200,000 to 300,000 square feet range. In fact, we bought two recently, one in Slidell, Louisiana, another one in Russellville, Arkansas. But these are in most cases, the dominant shopping center, typically in a secondary market, but one that's still growing, one that's not, solely reliant on a single employer. Where we think there's upside, not so much a broken asset, but really the dominant asset yet in the market, where there's either opportunity to replace, one of the anchor or the junior anchor tenants, or add value as far as developing the out parcels. In a lot of cases, parking ratios today for a shopping center are not what they were many years ago. Each of the shopping centers, as an example, were set up to be parked 5 per 1,000 per store, never factored in cross parking. So we see opportunities to unlock value. We're in the process of doing that right now. We're about to start construction on the Russellville Center that I mentioned for an Ulta mattress firm in Jersey Mike's. So we see those opportunities. And again, the key here goes back to the history and again, the relationships, and a lot of these centers, it's, they're centers where we have, strong, 40 plus year relationships with the tenants. And understand those assets where we think there's a number of opportunities to unlock value.
Excellent. That's a great overview. Thank you for that. The average construction set debt, I'm just kind of curious, when you're borrowing, what percentage of the 6 million is debt versus, I think you mentioned that 1.5 million would be equity. The rest of it would be debt, right? So about 4.5 million would be the debt. And what's the average interest rate on that?
Today it's about 8%.
Okay.
Typically about 8%. Usually 2 years IO in some cases with another 12 to 24 month extension option.
Okay. And so there's no cash flow until the end or when you sell, right? So someone gets their original million back plus their 8% pref and then the 50-50 after the split on that. So, and then that typically averages out to 20% IRR. That's a fair summary on those numbers. Yeah.
That's correct. In the case of the single tenant net lease developments,
right.
As a separate, I know we've not gone through the details, but the shopping center program I was just describing and acquiring shopping centers and adding value, there is cash flow in those investments. Plus there is upside, once we're adding those, value add components.
Okay. What's the average IRR on that one?
Correct.
What's the average IRR on that one, Grant?
Those are somewhere usually around 15.
Okay.
So I think those are somewhere 15 with the ability for those to move up to a 20 as we're effectuating the business plan, depending on what that is by the asset, but typically 15 underwriting, from the gate, but with quarterly cash flow.
Got it. Let's switch to capital gains tax, right? And so I think this is part of how we've met as well as we got connected through a mutual business colleague. And so capital gains tax, and I think the biggest challenge I found with developers is, they sell and then they turn around and they want to go to the next development. Whereas the 1031 exchange typically is not great for that because you're buying the land and it's going to take 36 months and you're going to want to, develop and keep going there. And so versus equal or greater value, equal or greater debt. So what has been your experience with capital gains tax and what's been your biggest frustration when it comes to the 1031 exchange?
Yeah, well, you said it, and again, a number of investments, we have LP partners, where we're the GP. And, by and large, typically we're ready and looking to invest in the next development versus buying a cash flowing asset. So it's really been, I don't want to say contrary to our business model, but again, as we've talked about, we've been programmatic. We've been about building a pipeline of opportunities. And so that's where we rather allocate our capital on a go forward basis as a company. And again, what's built our business over many years.
Exactly. Yeah. And so if anyone's listening and you're in a general partnership or you're an LP and again, most syndications, most funds, they're not doing 1031 exchanges, right? Now yours is a syndication model with the JV LLC structure. Is that how you do it?
That's correct.
Grant? Yeah. So in that model, there's capital gains tax. We can defer that capital gains tax using our capital gains tax solution and using a trust with an installment sale. We just did a $40 million exit for our client out of Nevada. And so it was an apartment sale. And so there's, 2 GPs and there's tons of LPs. We don't do it for every LP because they're smaller amounts, but one of the LPs had a $3 million exit and about $1 million in liability-ish, kind of around there. And so we were able to defer, instead of having 2, he had 3 for a trust. And then the other ones also had their percentages. And so they were able to defer as well. And the neat part was the funds can be diversified and they have diversified and they can also be used to go back into other projects with them or, passive or active. And so it's a you don't have to do a 1031 exchange anymore. If people want to learn more about that, go to capitalgainstaxsolutions.com. And so if you're a developer, you can also do the same thing for your own GP positions. And I call it do 3 deals, you have an extra 33% on average per deal. And so it's like 3 for the price of 1. So every time let's say you're selling for 6 million on each of them and you have your GP position, you do 3 of those. And with the deferral of the tax, it's as if you did an extra deal, right? Yeah. And that's kind of the model. If you can compound it, and hopefully that can accelerate the ability for you to do more kids academies, more opportunities. Again, if everyone wants to learn about that, go to capitalgainstaxsolutions.com. Okay, so let's see here. What haven't I asked you so far, Grant, that I think would be good for the listeners to hear?
Well, let me just go back for a second and say we appreciate your consideration as well. We do think with the structure that you presented us, that was something that certainly got our attention. Exactly like you said, it fits well, we think, within our business model on a go forward basis. I think to the question as far as what haven't you asked that you should have, one of our favorite questions is, to some extent, what does the pipeline look like? I know I've mentioned 2 projects today, both in the greater Omaha market. I'll say we've got 6 currently under construction, as well as an example 2 in the greater Kansas City market today as well. But, we think that there's the ability, to be 20 to 30 developments a year just within the single tenant net lease childcare space. As I said, we built the team to be able to execute on that from start to finish. And, I think that's an important aspect here for us. This really isn't looking at it on a one-off basis. We never have over, again, the life of the company. So 20 to 30 year just within that space. Within the shopping center acquisition space, we think there can be 1 to 2 acquisitions a year within that category. We're continually underwriting those assets. Those are typically going to be 15 to 25, 30 million. So larger check size there. Again, going in cap rates on those are usually, I would say in the low 9s, by and large, unlevered. Again, those are somewhere in the similar 65% loan to cost or loan to cost basis as well.
Perfect. Good. Thank you for sharing that. Excellent. We're running out of time. Are you ready for the lightning round?
Please.
All right. Knowing what you know now, Grant, if you can go back to your 20-year-old self, what's the one piece or golden nugget you make sure to tell yourself to do?
Yeah, sorry, repeat the question one more time.
Yeah, if you were 20 years old and you can go back to your 20-year-old self, right? What's the one golden nugget make sure to tell yourself to do?
That's a great question. That's a great question. I think going back, I would say continue to build relationships. I mean, I think starting from the beginning, seeing now the value that has, we're not a transaction business, we're a relationship business. So I think starting that as early as you can would be that first piece of advice.
Love it. Love it. Question number 2, number 1 book you've read in the last 12 months.
Hey Dad. It was things that we all thought that we'd learned early on from our dads.
Excellent. Question number 3, favorite leadership quote or theme that you strive to live by?
I will say it's from the business side, it's Warren Buffett, be fearful when people are greedy, be greedy when people are fearful, and I think we say that more from don't just always follow the crowds. I think form your own opinions, form your own thoughts, is an important driver for us.
Excellent. Love it.
Thinking strategically.
Love it. Next question. What are you most curious about right now?
How my daughter's going to take her first day of school tomorrow.
All right. There you go. Excellent. How old's your daughter?
She's 4.
4. Okay. It's a big deal. First day of school. Yeah. I thought you might say Jerome Powell, if he's going to lower these interest rates in September.
But that would be the traditional answer. That's a daily thought. So
no, there's no right or wrong answer. I think that's a good one. Question number 5. Number 1 way you guys are using AI or ChatGPT, or what's kind of even your take on that?
Yeah, we're still in the experimental phase. I mean, we really are. I think there's some of those easy day-to-day applications. I think a lot of people are saying, how can we use it for lease abstracting? If you're looking at, we've done this many different ways over the years. Typical retail lease is 75 to 100 pages, and, typically that's staff. So that's one application. I think that's more of a day-to-day administrative. I think we're trying to figure out how to be more strategic in the application. One, to an extent, we use another data source called Placer AI, which is a lot of the cell phone data. It's trying to track the housing growth trends, that aren't necessarily keeping up with the census data. So a lot of it is trying to be forward thinking and understanding where the housing growth is, which is what's going to drive childcare, retail, development opportunities.
That's fascinating. Thank you for sharing that. Last question, and it's kind of our theme of the Build to Billions podcast, which is, practicing a mindset of stewardship over ownership. So how do you best stay centered in your values, Grant, and also practice a mindset of stewardship over ownership?
Yeah. I mean, again, we've always been putting others first. I mean, that's our mindset. We're always the last one at the end of the day to realize any success in a project, and I think that's always been our mindset. Again, we have a brokerage division. Brokerage is a fee-based business. I always said we're never fee first. Again, we look at every project from an owner's perspective. We've tried to sit on every side of the table. So I think it's really about long-term success and adding value over any sort of short-term gain. And that truly is our mindset.
Amazing. Grant and Gary, I want to thank you on the show. I want to thank you for sharing your wisdom, your insights, diving into the details with your projects and the numbers. I want to encourage you to keep seeking opportunities that look great and executing on them, and also building these relationships with people long-term to make a difference and an impact, especially in the childcare space. That's incredible. My wife, a little side note, she child development major, and she ran a before and after school program for kids, probably very similar to the ones that the Kiddie Academy has there. And so that's a place in our heart for sure. We got 5 kids. And so it's a place in our heart for sure. So keep doing what you're doing, make a big difference and an impact. For our listeners who want to get in touch with you, would you mind one last time, what's the best place for them to find you?
Yep. Again, website is a great resource for ourselves. Again, Woodmont, WOODMONT.com.
Awesome. Thanks, Grant. Also want to thank all of our listeners for listening to another episode of the Build to Billions podcast. We're also watching it on our YouTube channel and also our other podcast, Capital Gains Tax Solutions podcast and YouTube channel. Hey, we're on this mission and this journey with you to scale from millions to billions so we can get more all of it away to help MVPs, the most vulnerable people. I want to encourage you to take action today. Learn more, grow more, and check out Grant, Gary, and with Woodmont's group. And I appreciate everyone listening or watching. We'll talk to you again real soon. Thanks now. Bye.